Did you know that some of the biggest financial scandals in history involved billion-dollar fraud? Get ready to uncover the secrets behind the scams that shook the world. Hey guys, welcome to See the Facts. In today's video, we'll explore the biggest financial scams in history, from Bernie Madoff's Ponzi scheme to Enron's stock market manipulation. We will reveal how these schemes were created, who was responsible, and the devastating impact they had. Bernie Madoff's Ponzi scheme. Bernie Madoff, a respected Wall Street investor, ran the largest Ponzi scheme in history, defrauding investors of an estimated $65 billion. Using his reputation and a facade of safe investments, he lured thousands of victims. Madoff promised consistently high returns and used money from new investors to pay old ones, creating a false appearance of success and sustainability. He used his credibility in the financial sector and the trust of investors to perpetuate the fraud. When the scheme collapsed in 2008, thousands of investors lost their savings, and Madoff was sentenced to 150 years in prison. This case has led to greater regulation in the financial sector and the creation of measures to protect investors against similar fraud. Enron collapse. Enron, one of the largest energy companies in the U.S., went bankrupt in 2001 after revelations of massive accounting fraud. The company used deceptive accounting practices to hide debt and inflate profits, misleading investors and regulators. Enron executives created a complex network of shell companies and off-book partnerships to hide financial liabilities and create the illusion of a prosperous and profitable company. They manipulated accounting records to show false financial results, inflating the share price. Enron's bankruptcy resulted in the loss of thousands of jobs, destruction of retirement funds, and a crisis of confidence in the financial market. The case led to the creation of the Sarbanes-Oxley Act, which reinforced transparency and corporate responsibility. 2008 subprime crisis. The 2008 financial crisis was triggered by the bursting of the U.S. housing bubble, driven by high-risk subprime loans. Banks granted mortgages to borrowers who were unable to repay, creating an unsustainable housing market. Financial institutions packaged these loans into securities, such as collateralized debt obligations (CDOs), and sold them to investors as safe investments, hiding the real risks. Lack of transparency and exacerbated greed led to the crisis. The collapse resulted in a global economic crisis, with millions of people losing their homes and jobs. The crisis led to significant reforms in the financial sector, including the Dodd-Frank Act, which implemented rigorous measures to prevent abusive practices and increase transparency. WorldCom fraud. In 2002, WorldCom, one of the largest telecommunications companies in the U.S., declared bankruptcy after one of the biggest accounting frauds in history. The company inflated its profits by $11 billion to keep its stock price high. WorldCom executives used fraudulent accounting practices to hide operating expenses and inflate revenues, deceiving investors and regulators. They recorded expenses as capital investments to mask losses. The bankruptcy resulted in billions of dollars in losses for investors and a major overhaul of corporate accounting practices. The scandal highlighted the need for greater financial oversight and transparency, leading to changes in accounting regulations. Scheme by Michael Milken. Known as the king of junk bonds, Michael Milken was convicted of market manipulation and securities fraud in the 1980s. He revolutionized the high-yield bond market, but also used illicit practices. Milken used inside information to manipulate the high-yield bond market, illicitly earning billions of dollars through complex schemes. He exploited regulatory loopholes and lack of oversight to maximize personal profits. Milken was sentenced to 10 years in prison, of which he served 2, and was fined $600 million. His case led to greater regulation of capital markets and the implementation of measures to prevent similar frauds by strengthening regulatory oversight. Today, we explore some of the biggest financial scams in history and how they shook the world. From Bernie Madoff's Ponzi scheme to the 2008 subprime crisis, each of these cases shows us the importance of transparency and regulation in the financial market. If you like this video, don't forget to leave a like, subscribe to the channel, and activate the bell so you don't miss any news. Thank you for watching See the Facts. Stay with us to explore more fascinating and eye-opening stories. To the next.